Hello, and welcome to The Explainer. Today we're setting sail into the often choppy waters of the shipping industry to take a hard look at Korea Line Corporation, a company that's been making some serious waves in the stock market lately.
You see headlines just like this one, right? Geopolitical tensions flare up and suddenly shipping stocks shoot through the roof. It's the kind of thing that leaves a lot of investors scratching their heads, wondering, okay, what do I do now?
So which one is it? Are we just riding a dangerous temporary wave, or is there a real solid value opportunity hiding beneath the surface? Well, that's exactly the question we're going to answer today as we break down the risks, the fundamentals, and the hard data behind Korean Line.
All right, let's dive right in. To really get this, we first have to understand the storm itself. The big external forces that are making all these waves in the market.
The biggest factor at play here is geopolitical risk. It's pretty simple, actually. When things get tense in a critical shipping lane like the Strait of Hormuz, the entire global supply chain holds its breath. That uncertainty drives up costs, especially for insurance, which means freight rates go up. And when freight rates go up, shipping company stocks can take off.
So how do we keep track of all these changing costs? Well, for shipping raw materials like iron ore or coal, everyone watches something called the Baltic Dry Index, or the BDI. You can think of it like a global weather report for the bulk shipping market. When the BDI goes up, it means shipping is getting more expensive, and that's usually great news for the shipping company's bottom line.
And would you look at that? The BDI's recent chart tells the whole story. It just blew past the 2,000-point mark. That's a huge signal of rising demand and rising rates. This, right here, is the wind that's filling the sails of stocks like Korea Line.
Okay, so we've talked about the storm. But in the middle of all this market craziness, how sturdy is the ship we're looking at? Let's talk about what makes Korea Line so stable, even when the seas get rough.
See, here's the thing. While some shipping companies are out there gambling on the day-to-day whims of the market, Korea Line has a powerful anchor that gives it a massive advantage, and that anchor is its long-term contracts.
Just take a look at this revenue breakdown. It's incredible. Over 70% of their entire business is locked into long-term, stable contracts with absolute giants like POSCO and Kogus. This means they aren't just hoping for good prices each day. They have a predictable, steady flow of cash coming in no matter what the market is doing.
And a huge piece of that stability comes from their fleet of 12 LNG carriers. These aren't just any ships. They're on essential, multi-year missions to transport liquefied natural gas. In fact, this LNG division alone accounts for roughly 40% of the company's entire operating profit. It's a true pillar of financial strength.
So, we have a company with a really stable business model. Now, let's go below deck, because the numbers suggest there might be some hidden treasure down there. I'm talking about some serious undervaluation.
First up is the price-to-book ratio, or PBR. And this is where things get really interesting. At around 0.4, Korea Line's PBR is incredibly low. What that means in simple terms is that the company's stock is trading for just 40% of what its assets are actually worth. You could theoretically buy the whole company, sell off all its ships and buildings, and walk away with more than double your money.
And part of that asset value isn't even ships or equipment. It's just cold, hard cash. The company is sitting on about 350 billion won. Now, to put that into perspective, that's almost half of its entire value on the stock market. That is a massive safety net.
And finally, let's look at the price-to-earnings ratio, the PER, and compare it to others in the industry. The story couldn't be clearer. Korea Line is trading at a PER of less than 5, while its competitors are averaging over 10. All this data is basically screaming that the stock might be significantly undervalued.
So if we've got a stable, undervalued company, you have to wonder, who's noticing? Well, let's follow the money and see where the professional investors are charting their course.
When you look at who's been buying and selling lately, you see this really fascinating split. On one side, you have individual retail investors who have been selling. But on the other side, the big players, institutional and foreign investors, what they often call smart money, have been consistently buying shares.
This kind of pattern is often a huge signal. It suggests that the people who do this for a living, who do the deep dive analysis, are seeing long-term potential here that maybe the average person is missing. They're looking right past the daily headlines and focusing on that underlying value we just talked about.
All right, we've covered a lot of ground, so let's bring it all home and turn this into a practical guide. Think of this as your captain's log for how to navigate these waters without getting seasick.
If you're thinking about investing in a cyclical industry like shipping,
Here's a simple 3-step game plan. First, don't go all in at once. Use split buys to average out your purchase price. Second, look for logical entry points. For example, history shows a strong support level between 2,260 yen and 2,485 yen, which could be a place to look when the market dips. And third, and this is the most important one, think long-term.
At the end of the day, investing in a company like this isn't about chasing the latest news flash. It's about having the patience to trust the fundamentals, those long-term contracts, that strong balance sheet, and that potential undervaluation.
So with all that said, the real question is for you. Do you see a passing storm you should avoid, or do you see a fair wind that could take you to a great opportunity? Ultimately, where your investment compass points depends entirely on your own strategy and your own goals. The key is to navigate with data, not just gut feeling.